Yesterday, a bombshell news story hit the Bloomberg terminals. Apple is abandoning the Titan project. In other words, Apple has admitted that it can't produce a smart electric car. It's said that there are over 2,000 employees working on this and that they will be reassigned to other departments. It's hard to know exactly how much money Apple spent on this, but it was a project that lasted 10 years. And if there were always 2,000 people working on it, and considering that Apple employs some pretty high-cost people, a serious amount of money has gone down the drain. Now that Apple is pulled out of this, people are wondering, is the electric car business a dead end? If even a company like Apple thinks it can't succeed in this business, does that mean electric cars are dying? Especially with the recent news that Mercedes was supposed to go fully electric by the end of 2030, but they've backed out of that. And then yesterday, there was similar news from Audi. Ford is also having a really tough time. When you put all this together, people have started to say that maybe electric cars are dying. So today I've prepared some really interesting information for you on this topic, based on solid numbers, data, statistics, and automotive history. By the end of my presentation, you'll see that most of what's being talked about is just empty chatter. And unfortunately, our automotive media, just like our rote learning economists, are pretty lacking in knowledge. If you're ready, let's get started. Bloomberg's headline, Apple is giving up on its decade-long journey. Now, the team is being shifted to other projects. Bloomberg says that one of these projects will be artificial intelligence. Apple dedicated a lot of resources and time to this, but they couldn't figure it out. In my view, there are two main reasons for this. One of them is that Apple isn't really a strong player in artificial intelligence anyway. And when it comes to autonomous driving, they don't have any data. Without data, I never expected a company that hasn't shown any significant success in AI so far to be able to compete with firms like Tesla, which have already made great strides in fully autonomous driving. Secondly, manufacturing cars is a tough and costly business, and more importantly, it's a matter of scale. If you haven't watched this video of mine before, you definitely need to check it out. In that video, I also said that the price of electric cars needs to drop below $25,000, because that's where the big market is, and electric cars are gradually getting closer to that point. So how are they going to get there? By scaling up. By the way, this video that popped up on social media yesterday really made me laugh. Maybe some of you already know about it. Apple's Magic Mouse has a weird charging system. You have to flip the mouse upside down and plug in the charger like that. People have been making fun of it, saying Apple couldn't figure out charging. Of course, this is just for laughs. The first person to realize that the real issue in the automotive industry is scaling, and that the main way to grow is to bring people together with an affordable vehicle, was Henry Ford, along with his famous car, the Ford Model T. Before Henry Ford's miracle of the production process with the Model T, cars around the world were being made in small workshops. We can consider Mercedes as the main inventor of fossil fuel cars. Even they were making these cars in workshops. They were produced at extremely high costs and with intensive labor. Because of this, car prices were quite high, and that's why they weren't very popular. This famous photo of New York's Fifth Avenue in the early 1900s is packed with horse-drawn carriages, as cars were a luxury. There's just one car over there, and interestingly, it's electric. Because at that time, the battle between electric and fossil fuel cars was still ongoing. Later on, Henry Ford made sure fossil fuels won the game. There were so many horse-drawn carriages in New York at that time that there was actually a serious horse manure problem. They even held tenders to clean it up. It was always a major issue in New York. Henry Ford, who believed that cars were a better vehicle than horses, thought, how can I solve this problem? He says, by lowering the prices of cars and making them easier to use. This is still at the core of every innovation. If you lower the cost of something and make it easier to use, the number of people using it increases. You end up creating a massive business. Henry Ford thought, how can I solve the cost problem? When he asked himself that, he came up with the idea of moving from workshop-style production to assembly lines. So instead of workers going to the car, he envisioned a new model where workers stayed in place, assembly lines moved in front of them, each worker specialized in a specific task, and coordinators managed these specialized workers to ensure efficiency. By the way, he's also doing some pretty ambitious things. For example, to avoid wasting time, he wants the vehicle to travel as little as possible inside the factory. Because of this, he also wants the parts to move as little as possible, and even comes up with wild ideas like bringing ships right into the factory. And ultimately, as a result of all this work, he launches the Ford T. When the Ford T was launched, it faced reactions similar to those electric cars get today. People who were used to much higher quality, more solid cars looked at this vehicle. They said things like, this one's kind of flimsy, isn't it? But the car was so affordable and so easy to use that it started spreading rapidly all of a sudden. One of the slogans was, "Even women can drive it." Of course, it's easier to drive than a horse-drawn carriage. It's clean. After all, it doesn't leave horse manure behind. And it's cheap. And that's the most important thing. When it first came out in 1909, the price was around $950. That year, they were able to sell 12,000 cars. Later, the price dropped to $780. That year, 19,000 cars were sold. By 1916, they dropped the price of the car to $360 and sold 577,000 units. They kept lowering the prices. Why? Because production kept scaling up. They were producing more economically and with greater efficiency. Thanks to this, as they lowered the prices, their sales kept growing. I don't know if this sounds familiar, but I guess Tesla, BYD, and some other Chinese companies are on a similar journey. When we look over the years, costs have also gone down along with it. We'll talk about this in a bit. There's even a name for this. It's called Wright's Law. And as production increases, a lot of numbers change, both because of learning curves, meaning people get better at doing the job, and because it changes in purchasing power. You can see that the cost of cars keeps going down. By the way, Henry Ford also realized that the key to continuously lowering costs was not to change the model too much. He says, if we keep producing the same model, the workers will become more specialized, will deal with fewer types of parts, and the production lines will be simpler. And for many years, he sticks with just one model. Later on, he adds a bit of variety, but as you can see, it's really just some minor body changes built on the same base. Henry Ford has a famous saying, "I can make any color you want, as long as it's black." This idea of scale has now also taken root in the minds of Tesla and Chinese car makers. You need to have a small number of models. Production processes must be made extremely efficient, and you need to reach very high volumes with just a few models. Henry Ford's battle with costs pays off. In 1913, just 13 years after that photo, we're on the same street in New York. As you can see, there isn't a single horse-drawn carriage left. Cars are everywhere. But during those 13 years, people kept arguing that horses were better and that cars would never succeed. Just like what's happening now with electric vehicles. But actually, the issue is fundamental. If something's more efficient, easier to use, offers a better experience, and is more economical, people eventually gravitate toward it. The law I just mentioned about cost decreasing is called Wright's Law. The basic idea is that every time you double the cumulative production of any product, the costs will decrease by a certain factor. For example, in the automotive industry, if you keep producing the same car without making major changes, the production cost of the 2 millionth car drops to 15% below that of the 1 millionth car. So far, Tesla has produced around 5 million electric cars. So I'll leave it to you to calculate how many times they've managed to lower their costs. Meanwhile, competitors have produced very few units. That's why, just like Ford once did, now Tesla, BYD, and there's one more manufacturer, Li Auto, which we'll talk about, are leading the way. There aren't many traditional car manufacturers who can follow a similar path to the one they've taken. That's also why hardly anyone is making a profit. Here we see various luxury electric cars, though I agree it's debatable how luxurious the Model Y and Model 3 really are, but at least in terms of pricing, they were considered luxury for quite a while. We can see their sales numbers and the price range they occupy. But actually, the area we need to focus on is more like this region. For example, BYD also has some really cheap cars. These are only sold in the Chinese market. Even so, their sales numbers are way above those of expensive European models. So right before our eyes, BYD is doing this in the Chinese market. Tesla, on the other hand, is doing it on a more global scale. They keep trying to lower prices while scaling up production. This is an issue that's killing these electric car startups. Because unlike traditional car manufacturers, they don't have alternative sources of income. The only place they can make money is from producing electric cars. But take BMW or Ford, for example. Sales of fossil fuel vehicles haven't ended yet. They're managing to get by thanks to that. But for pure electric car makers, there's really a problem. For example, let's take a look at the cost of Rivian, which I really like as well. According to the latest financial statement, Rivian loses exactly $113,000 on every car it produces. Rivian produces around 55,000 cars a year, and by the way, they're not expecting significant growth in 2024 either. It's also worth taking a look at the gorgeous Lucid. Lucid loses $377,000 per vehicle it produces, and the number of vehicles it managed to produce last quarter was around 2,400. Next year, they'll produce 8,000 vehicles, so they're nowhere near the scale needed. When we compare these numbers to Tesla, Tesla produced 1,800,000 cars last year. This year, they'll produce at least 2 million cars. BYD's electric car sales numbers have caught up with Tesla. And on top of that, BYD also has hybrids and fossil fuel cars. So BYD has also reached a serious scale. Li Auto is heading in that direction too. Plus, you need to build factories to be able to produce cars. This also requires a serious investment and means you have to spend cash up front. When we look at it, we see that the vast majority of car companies have negative cash flows. Rivian's situation is getting worse and worse. They're constantly burning cash. They're burning about $1.5 to $2 billion every quarter. Here, we can see that only Tesla is showing a positive picture. So what's the situation with traditional car manufacturers? They're large scale, they're big, but unfortunately, almost none of that scale is useful when it comes to electric vehicles. The materials used are different, the optimized production lines required are completely different, and the skills the workers need to have are different. That's why, for traditional car manufacturers, producing electric vehicles is really no different from starting a new startup. Since Ford has shared the most transparent data on this topic, we'll first take a look at Ford, then move on to Mercedes, and try to understand how electric vehicles have become such a headache for them and why they're so eager to get rid of or postpone this transition. For example, here's a news story about Ford. They gave up on the factory that was producing batteries for electric cars. Why? Because Ford didn't like electric vehicles. Because they're losing too much money. When we look at the latest quarterly financial results, Ford's revenue increased by 4%. That's pretty good, but we're seeing declines in EBITDA, a 59% drop and a 3.5 basis point decrease. Again, we're seeing a drop in cash flow and a decrease in earnings per share. The main reason for this is what they're experiencing on the electric vehicle side. Look, Ford is a bold company. I respect that. They're the ones who openly share just how much trouble they're in with electric vehicles. They can't grow their revenue in electric vehicles. On top of that, profit margins keep heading further into the negative. They also can't increase their sales numbers. Because of this, they're taking huge losses. And they say, yes, when we look at it annually, there's a 20% increase in volume, but our revenue could only grow by 12% because we're facing serious price competition. And our profit margins aren't good either. We're dealing with very high costs, there's competition, and so on and so forth. Because of this, Ford is losing around $2 billion on electric cars. Let's thank Ford once again for this transparency. Here we can see just how much a traditional car manufacturer can struggle, and at the same time we see that it's even impacting their main model. So that's the situation at Ford, but what about the Germans? The Germans know what they're doing, right? Especially Mercedes, they know their business even better. After all, there's something special about that star. It's one of the brands we Turks love the most. So what's really happening at Mercedes? Remember what Mercedes said before? They said that by 2030, all their cars would be electric. Then they said, well, we don't think there's that much demand. We'll only be halfway there by 2030. So is the lack of demand real, or does Mercedes have another problem? When we look at 2023, we see that Mercedes revenue barely increased at all. There's only a 2% increase, from $150 billion to $153 billion. And its revenue increase isn't coming from cars. When we look at EBITDA, profitability dropped from 20.5% to 19.7%. That's a significant 4% decrease. When we look at earnings per share, it fell from $13.55 to $13.46. That's a 1% decrease. It's not too drastic. There's a significant climb in net cash flow, but that's actually because they've postponed some investments. So that's why it appears that way. They have a concept called net industrial liquidity. I don't know what that means. They've seen an improvement there. All right then, Professor, it doesn't seem to be going too badly. Look how nice the numbers are. Now we need to get into the details. I don't look at the headlines. I'm interested in the details. When we look at the automotive side, we see that sales have remained flat. That's not a good sign. Remember, Tesla sold almost 50% more cars this year compared to last year. To 2.04 million. 2.04 million. Revenue has also remained flat. It went up from about 111.6 to 112.8. On the automotive side, there's a 12% loss in profit margin. Ugh, that's really not good. When Tesla experienced similar profit losses, it was a huge deal. Here, they've dropped from 16% EBITDA profitability to 14.3. These are in $1 billion in euros. Why is this happening? Because the share of electric vehicles at Mercedes is growing rapidly. Look, last year, Mercedes sold 2,044,000 vehicles, and the year before that, 2,041,000. So there's almost no increase at all. And whatever increase there is comes entirely from electric vehicles. So-called top-end models, G-Class, Maybach, AMG, S-Class, EQS, GLS, and EQS, meaning the electric ones too, are included. They're not really increasing much. The numbers here are staying about the same. In the so-called core segment, like the C-Class, there isn't much growth. There might be a slight increase in entry-level vehicles. Where's the real increase coming from? It's coming from electric car sales. While last year they sold 333,000 vehicles, this year it's 402,000, a 21% increase. It's not a huge increase, but it's still an increase. What does this mean? Mercedes-Benz is seeing that demand is shifting from the fossil fuel vehicles, which they know how to profit from, toward electric ones. They're the ones reporting this. I'm not the one reporting it. You know how they said there was a lot of demand for fossil fuels? Well, that stayed the same. So where's the increase? The increase is in electric cars. But Mercedes is probably taking a big loss on electric cars. They're not sharing that with us. That's why it's really hard to know. Mercedes-Benz doesn't have a dedicated factory just for producing electric cars. As far as I know, they're trying to produce these vehicles in their existing factories. That's why they haven't achieved the production efficiencies I mentioned with Henry Ford. Maybe they're losing as much money as Ford. It's a company that's a bit better at selling its vehicles at higher prices. Maybe that's why they're able to maintain their profit margin, but since they're not sharing this with us, the situation probably isn't that great. And as you can see here, Mercedes itself is saying, I can't grow fossil fuel vehicles anymore. Growth is coming from electric vehicles. Overall, I can't increase my total car sales at all, even with the contribution of around 70,000 from electric vehicles. What does this mean? There's a drop about 70,000 in fossil fuel vehicles. Look, this is Mercedes. There's actually just one category that's driving Mercedes' real growth. Vans. You know, the Vitos we all know. Compared to the previous year, there's an 8% increase in units. But even here, interestingly, the growth is coming from electric vehicles, as about 51% growth in electric vans. Now, do I really need to explain these numbers to you any further? Mercedes is saying it themselves here. In other words, we can't increase sales of fossil fuel vehicles. Electric vehicles are increasing, but then the profit margin drops. That's why we want to cut back a bit on electrics. What are they trying to do? They're trying to escape. Where are they escaping to? They're escaping to vans. They're escaping to luxury fossil fuel vehicles. They're making these weird ultra-luxury electric cars called EQS to protect their margins. But they've already lost. It's inevitable. Because competitors, especially the Chinese, like companies such as Zeekr, are producing ultra-luxury vehicles that appeal to Mercedes' customer segment, but they're much more affordable and electric. We're looking at a statistic from Bloomberg. We see that fossil fuel vehicles hit their peak sales in 2018 or 2017, and they've been declining ever since. Look, the decline continued in 2023, and it's going to keep going in 2024, 2025, and 2026. And I actually think these declines will be even sharper than this, because on the electric side, battery costs are dropping sharply. So it's going to get even harder for these traditional companies to sell fossil fuel vehicles. Now, some of you might say, I would never use an electric car. There are range issues and so on. I actually compare this to the comments made by people who used to ride horse-drawn carriages back in the day. In our daily use, we drive these cars for 40 or 50 kilometers at most. And the range of these vehicles is more than enough for that. When you go on a long trip, if you're a typical car user, you only need to charge on the road once or twice a year. And those charging times are getting faster. The real important thing is the price, and the prices of electric cars are about to drop below those of fossil fuel cars. How do we know this? We know it from the developments in battery costs. You might be surprised, but battery costs also follow Wright's law, and as the number of batteries produced worldwide increases, their costs are dropping rapidly. There's a super concrete piece of news about this. John Raymond Hanger shared it on Twitter. CATL is the largest battery manufacturer in China. They say they'll cut battery costs by 50% within this year. 50%? So, for example, if your car needs a 60 kilowatt-hour battery, its cost will drop from $6,776 to $3,338. What does that come to when you convert it to Turkish lira, for example? That's a cost saving of 110,000, 120,000 lira just on the battery. At the same time, Tesla and the Chinese are achieving scale in electric vehicles. In other words, cost advantages are being achieved in the other components of the vehicle as well. When we look at it this way, we see that electric vehicles are increasingly becoming a better option than fossil-fueled ones. There will be a tipping point for this. We're going to experience this tipping point suddenly. That sudden shift is coming in 2024 or 2025. At that point, electric cars will become so advantageous compared to fossil-fueled cars in terms of cost that we'll experience changes similar to what Henry Ford did to horse-drawn carriages. We're very close to that point. Tesla and the Chinese are leading the way in this field. Unfortunately, none of the traditional manufacturers are even close to these scales. We just looked at the numbers together, and after that moment happens, we'll see a transformation similar to what Henry Ford did to horses. Here we see the sales figures for Henry Ford's Model T. And here we see the decline in the global horse population. There are brands that I see as strong in this transformation. One of them is of course Tesla, and another is BYD. There are also a few players from China. Among them, Li Auto really catches my attention. Li Auto is scaling up very quickly. They're increasing their gross profit and their operating profit. It's truly an interesting option, but traditional car manufacturers are in trouble. They're already chasing strange solutions within alliances that are in trouble. One of the news stories that made me laugh the most this week was shared by Emre Özdemirci. Renault CEO Luca De Meo says, "We Europeans need to unite." Only if we unite, like we did with Airbus, can we deal with electric cars coming from China. Airbus and the automotive industry are two completely different worlds. And bro, you're already way too late. Because the Chinese invasion and the Tesla invasion are both going full speed ahead. Next year, you're going to be in even more trouble. Now, everything I've talked about here is based on numbers. I present the data for all of it. You can believe whatever journalist you want, whatever commentator you want, but numbers don't lie. Wright's Law keeps working like clockwork. Scale in an electric cars continues, and costs keep going down. And there's nothing traditional car manufacturers can do about it. Take care. Goodbye. See you next time.